Okay, welcome everybody to episode 58 of the Volatility Barometer podcast. So if you are new here, my name is Brent Osachoff, and we talk about everything investing related. So volatility trading, options trading, shorting VXX, UVXY, all that fun stuff. VIX futures, risk management, tactical investing, volatility targeting, all that good stuff. So if you are interested, of course, don't send me any money, don't super chat. Podcast is always free. But if you are interested, dive a little bit deeper. Everything we talk about today, of course, in our private community, we go 10 times deeper. So if you are interested, there is a free trial for everybody on the website. If you've taken it before, feel free to take it again, multiple times if you want to. You're not going to hurt my feelings. There's no obligation. You can cancel anytime. But if you are interested in these topics that we're going to discuss, it is available for you. So today on the rundown, I think we've got a good one today. I think you're going to like it. So first thing we're going to do is we're going to take the VIX index, divide it into quintiles, and I'm actually going to show you how a short VXX position would have performed in each of those ranges. So right now, you can start thinking about which range you think it would be, which is the best one. Is it the really low ranges on the VIX, below 12? Is that the time to short the VXX? Maybe it's the super high ranges. I don't know. Whatever you think, start thinking about it now, and I will give you that answer. And then we're actually going to take that information a little bit further and start the entry-level strategy building in case you're interested in doing something a little bit more with your volatility trading than basically doing this and shorting with your eyes closed. The old buy and hold, it's not going to work in the volatility space. So we're going to start building a very simple strategy with that. After that, we're going to talk about the Wheel of Fun strategy. I opened a live trade last week in last week's podcast. We're going to close that one out, open a new one, and I will explain the strategy again today for anybody who doesn't know about it. I did mention the social media fails, but to be honest, we got a lot on our plate, so probably have to bump that to next week. But those are always fun. They're really cringy, so maybe I'll do a couple extra ones in next week's podcast. But start asking your questions. We do a live Q&A. Anything that's on your mind, investing related, life in general, whatever you've got on your mind, put it in the comments section. I will make time to get to all of those. So let's get into the show. Okay, so just give me a couple seconds here. My wife just texted me, says she can't find my live stream. So let me just click through a few things here. I just have to make sure that we are actually live. That would be quite embarrassing if I did this wrong, which, it wouldn't be the first time. Let's see what's actually going on here. Sorry, you're just going to be staring at me for a second here. Live, everything looks okay on my end. I don't know. Hold on a second. Yes. Oh my God. She is correct. I had it unlisted. I wonder what that's going to do. Is that going to affect things? Just think for 1 second here. It was unlisted. That is unfortunate. So technical difficulties already. What a fail that is. This happens though. So I'm just going to push through. So what we're going to do is we are just going to go ahead and dive right into our first segment. Okay, so let me put on a screen share, and essentially what we are going to be doing, like I said, this is going to be VIX index related today because everybody has access to the VIX. It is one of the most popular, most widely referenced volatility indexes. So personally, and if you've followed my live streams, you already know that the VIX futures are definitely better. The VX30 to VIX roll yield, far superior. Cash VIX term structure, the volatility risk premium. There's many ways that we can actually do a lot better than what you're going to see here. So like I said, this is just an entry level stuff to give you some ideas, and then we will build over time. So make sure you are subscribed to the channel. We're going to keep going with this a lot further than what you see today. But we're going to start with the VIX index. So this is the VIX. It was launched in 1993. We can backtest it to 1986 and see the crazy action in October 1987. But what I'm doing here is I'm going back to March 26, 2004. The reason for that is because that's when the VIX futures launched. So in future episodes, when I start actually putting in the VIX futures and the actual metrics that I use more in my own trading, it's going to be consistent. So that's why I'm doing it. But you can see very large range. Everybody knows the VIX can get quite low, can also get quite high. The VIX average is about 20. If you walk around saying the average VIX is 20, you're not going to be too embarrassed. But the truth is, that is what's called the mean. That's the average if you add up all the values and divide by how many there were. Now, it does get into the 80s sometimes. The highest is 82.69. So it kind of pulls up the average. So what I like to look at, probably the median is a little closer to what you're thinking for an average. And that's about 1750, give or take. And then I always have to mention this, that because everybody says it's a mean reverting index. That is true. But you should also view it as a mode reverting index. And mode is the most frequently occurring value in a series of values. So you can see that the VIX, while it is about 1750 for the median, it does spend an awful lot of time from 11 to 14. So if you said what the average VIX was, if you said 15, that's a really good ballpark. Anything over 15 is getting elevated, in my opinion. Okay, so what would you do if you were doing a short volatility strategy? In my opinion, one of the first things that you would do, and this applies to whether you're stock trading and you're trying to improve on the S&P 500, whether you're option trading, whatever it is that you're doing, if you're building a strategy, probably the first place you would start is to look at what the buy and hold does. Because if that's good enough, and if you feel like that's what you want in your investing, then you don't have to go any further. You're just going to buy and hold. So the first thing that we're actually going to look at, I don't know how many people actually crunch these numbers or look at these things, but what is a short VXX buy and hold? What does that actually look like? So I've got those numbers here. This is what it looks like. This is not a log scale. I'm just showing this because I had a question just before we went live here. Somebody wanted to know because basically from 2016, you can see here, all the way to right before the Volpocalypse event in February 5th, 2018, that was basically a golden era for the short vol trade. So the person asked me, well, what would this look like if you just remove that period? Well, I've got the answer, and I'm just answering the question for that person. But you might be interested as well. Obviously, not so great, right? Missing that period, you're going to miss out on a pretty substantial part of the gains there. But this is a log scale, so you can see now everything scales over time, and visually it all looks the same. So what are we looking at? Buy and hold, basically, 24% annual return. Everything you can see, this is as expected. There's several periods, several waves up, I guess, of those golden era trades, maybe 3 to 4 years long, where the short volatility trade cooperates quite well. Obviously, the big problem is that it can be catastrophic, and we can take massive losses if you're just hanging on for the ride. That's, you can see here, 92% drawdown. Now, I don't know. I don't like to say anything too general, but in my opinion, there is no investors that can sustain a 92% drawdown, go to sleep, actually get some sleep, wake up the next day. Yeah, I'm just going to keep going with that. It just doesn't exist. So there's a lot of people who might look at that, think, oh, 24% a year, that's pretty good, right? And it is for a 20-year track record. Nothing wrong with 24% a year. That's world class. But you can't sustain a 92% drawdown. You just can't. I find that most investors wildly overestimate their own risk tolerance. Sometimes they look at these charts and they think, well, yeah, that would be uncomfortable, but maybe I would do it. No, it's not just uncomfortable. It's not just the magnitude either. It's also the duration of that drawdown. So if you look here, you can see from February 2007 to December 2012, which was almost 6 years, the short VXX buy and hold was in a drawdown, a 6-year drawdown of 92%. You can't sustain that. And there was another 92% drawdown recently. Right now, from basically just before Volpocalypse in 2018 up until today, we are in a significant drawdown still. The short vol trade has not yet recovered, quite far away from it actually, back to that February 5th, 2018 Volpocalypse event. So if we go another, 8-9 months here, this would be the new longest running drawdown. So again, it's not just the magnitude of it, it's also the duration. You don't want to tie up capital in a drawdown for 6 years, I hope. So what we're going to do, and like I said, this is an entry-level thing, but when you're building a strategy, one of the things that you should probably do first, before we get into the really complex stuff, before we really try to fine-tune things, first thing you want to do is attack that low-hanging fruit. You just want to take whatever you're trading and you want to try to eliminate the most obvious, bottlenecks that you're experiencing. The times, in this case, shorting VXX, when are the most obvious times that you could just exit to safety, sit on the sidelines, and maybe save yourself a lot of trouble? So I'm using the VIX. I wouldn't normally with trading, but trust me, in future live streams, we will definitely get to the VIX futures and all that stuff. But what I've done is I've divided the VIX index up into quintiles. So a quintile, as the word suggests, is 5 equal portions. So we're talking about 0 to 20, 20 to 40, etc. Lowest VIX ever was 914, highest was 8269. So you're talking about the range between these two being the lowest 20, here's the 20 to 40, etc. So when you're looking at this, as I said, as you're thinking about this, when do you think is the best time to short the VXX? Because I could make a case here for several of these different ranges. On the one hand, this low range, you could make a case that that might actually be the best time to short volatility, right? To short that VXX. Because when volatility gets really low, that probably means the stock market's doing well at that period. And wouldn't that be a great time to short volatility? You're just riding that stock market doing extremely well. On the flip side, what about that 80 to 100 range? Some people might think that's the time to attack. And I certainly get a lot of questions on that. When the VIX gets to 25, I get bombarded with emails. Isn't now the time to short volatility, right? And you can kind of make a case. If you short it when it gets high, aren't you going to be able to ride it down? So what about the middle range? Maybe the 40 to 60, maybe that's the sweet spot. So I'm going to give you the answer right away. It's a live stream, so I can't delay and build it up into this anticipation. I'm going to give you the answer, but just think in your head, where do you think the best period to short the VXX would be? Just 5 equal segments on the VIX index. Here's your answer. So what I did is I went through all the numbers. Of course, I love to do these back tests for everybody, present the data. I should probably do a little side tangent here. A lot of people look at this, they think, oh, why are you doing that? I know this AI software or this really cool backtesting software. It can do it for you much faster. The reason that I do old school Excel way, I just, grab a couple of coffees and it might take a few hours, but I like going through long form because when you're backtesting a strategy, it's not just about getting the number. That's actually the least important part of the system. What you're really trying to do is learn along the way. So if I do something and I automate it all and I just hit a button and it spits out an answer, yeah, I can go from A to Z, but I just skipped over all that good stuff in the middle. So I always get a little note sheet out and record anything that happened. If I see a few of the numbers like, hey, that's interesting, the relationship there, maybe I'll circle back. I'll make a little note. Or if I see something that stands out, glaringly obvious, I'll say, oh, well, maybe I'll do another test later. I'll have to skip that part. You don't want to actually speed through your back testing. Trust me, do it old school manual with Excel. You'll learn way more in the process. Anyway, this is your answer. So pretty messy to look at. We're going to go through each one of them individually, but you can see there is one clear winner. I don't know who in the chat section, if you guessed right, the 60 to 80th percentile, well, good for you. But we are going to go through all 5 of these sections, and I'm going to kind of explain why this might be. So the first section, this is an interesting one. This one often confuses people, but this is the lowest volatility on the VIX, 0 to 20th percentile from the lowest ever 914 up until 1286. And you can see, aside from early on, the first 3 years, it's basically flat, almost negative. In the last 17 years, it's negative. Now, why would this be happening? If you think about it, when would the VIX be low? Well, that's when the stock market's doing well, like I said. But it could also be a time when the stock market might be running on fumes, right? Doesn't necessarily mean that there's going to be an imminent VIX spike. A lot of people make that mistake. They think, oh, the VIX is at 11. load up on VIX calls. It's going to spike any second. No, it doesn't mean that. Volatility can stay low for a very long period of time. But the point is, when it gets to those low levels, it takes an awful lot to keep that market going. So that's actually a range where not a whole lot is happening. This 0 to 20% range, basically flat. If you were to just remove it from your strategy and just not short vol when it gets this low, that would be backed up by historical data. So the second range, 20 to 40, this is a good range, right? And no surprise, I don't think we have to talk too much on this one. What's happening there? Of course, the market is capitalizing on longer term trends when this happens. Now you can see there are some flat periods. Of course, that's because this is the financial crisis. It's very difficult for the VIX to get below 15 after a major spike. So you can go years without seeing any of these values surface. Same thing recently. And after the COVID crash, we did dip below 15 very temporarily, but again, certainly running on fumes at that point. So you're going to see a lot of flat lines. But this is a good section of the market. This one is interesting. Now, this one takes a little bit more explanation. So you would think, or at least, most of us, I think, who trade vol a lot would think that this is the sweet spot range. And for any stable market periods, you'd be right. That 40 to 60 is the best spot when the markets are cooperating. But therein lies the rub, because it's also a range where you do see values during recessions and down periods. Whereas this range, very difficult to see them. So you're not really seeing a whole lot of negative action here. Same thing here. VIX is never going to get to 1286 after or during a recession. But this is the range where if things are not going well in the market, it's going to show up a lot in this center range. There's going to be a lot of whipsaw, a lot of choppiness, and you can see that it performed very well early up. Financial crisis, it slipped. Exceptional performance all the way to 2018. And in the last 5 years, it's been rough, right? The short VXX is actually substantially down in that 5-year period, and it's going to show up here a lot. I can also illustrate that with my volatility barometer. Remember, this is my own index that I created. This is all my volatility metrics combined to make an index. So the volatility barometer, essentially one of the centerpieces of my work. We do use other metrics as well. Cash VIX oscillator, traders VRP is a good one. A lot of metrics here, but I basically combine all of these things into an index, and we can see the volatility barometer. Kind of hard to see on a long-term chart, but there does seem to be a little bit of an elevation over here. I don't know if you can pick that up, but if we go down here, now you can see it. So this is what I call the volatility regime change. This is showing before Volpocalypse in 2018 versus after. And this is a massive difference. Look at the average from 40.58 all the way up to 56.12. Huge volatility regime change right at that Volpocalypse event. So all those values that were not really showing up before 2018, it would just blow right through it, and it would actually go into these lower ranges. Now, since then, it's not. It's hanging around in that middle range of volatility, and that is obviously hurting the results here. So the volatility trade is not dead. It will come back to a point where it starts doing really well again. That's what happens in good, stable bull markets. But we are basically dancing on the knife edge of a recession for quite a while now. So that's a little bit unfortunate. Here's the best range. This is the 60 to 80. And not very surprising here. What's happening here, and especially if you were to divide it further, like 60 to 70 is better. 60 to 65 even is really good. It's just that cusp between upper 1/3 and lower 2/3 vol. That's a real sweet spot for the short vol trade. So not a lot to say here. This is the top performer. If we go to the last one, this is what I was talking about, low-hanging fruit. Clearly, this is not good. This is where that 92% drawdown happened. This is when the VIX gets to 24 or above. So a lot of people think, and this is maybe a good side lesson here, a lot of people think that when the VIX gets to those mid to high levels, that's when you should short vol. And I know intuitively what people are thinking when they do that. But historical data does not back up that statement. This is why I always say that the best time to short vol is during mid to low. And the historical numbers back that up. The worst time to short vol is during high volatility. Contrarians always think the opposite. They think they're going to be the first one in there and they're going to make all that money when it crashes. What actually happens is sometimes they do. If you look at this chart, there were exceptional periods of performance, but there's just as many times it goes against you and you just ride this excruciating drawdown 90% or more. So being a contrarian in the volatility space doesn't actually work. I only go long volatility about 2 to 3% of trading days. And when I go long vol, it is during these very high volatility ranges. People think that's counterintuitive, but that's actually how you make the most money. Go long volatility when there is a clear and present reason why the market is melting down, and then avoid everything else, have a very healthy cash position, and then, of course, short vol during mid to low. I think people would have the best results doing that. Okay, putting all of this together, what would I say? Basically, in general, like I said, eliminate low-hanging fruit. So just today, this is, again, entry level. We're going to go way further in the future. But today, it's pretty clear you should eliminate the 80 to 100, right? This is not worth holding. There's nothing there that is really attractive long-term. And you can certainly make a case to just eliminate this because there's no performance coming from that either. So if you're just going to hold vol 60% of the time, where would you hold it? Well, you would probably hold it in the 20 to 80th percentile, and you just do something else in the others. This is actually consistent with the VTS portfolio as well. Not exactly, but you can see we have 5 strategies with 20% weighting each. They're all independent of one another, but you can see that we kind of do mimic that. We can see that in the really high volatility periods, we are in cash, utilities. That's not a great time to go long the stock market. This is our basically the heart of the strategy where we're using the NASDAQ. And then down here, super low volatility, not really worth holding the NASDAQ down there either. We are holding bonds. Now this strategy, just for diversification purposes, it doesn't exit stocks on the low end. It will go ahead and continue holding the Dow Jones. This strategy down here, the strategic tail risk, of course, long volatility when it's very high and elevated. That's that trend following volatility I'm talking about. Don't be a contrarian. That doesn't work. But on the low side, over the last several years since we've launched VTS and these strategies, sometimes we do throw a gold position down here as well. Because again, not a whole lot of reason to be holding that low end. So if you want to see what that looks like, here's the final results. This is holding vol 60% of the time when the VIX index is 1286 to 2415. Now, this isn't great. This isn't anything to write home about, but I believe that it is definitely better than buy and hold is a complete non-starter, 92% drawdown. I mean, come on, that's awful. But if somebody has the buy and hold on the S&P 500, they're only making a 7% return. This is a 20-year period, and that's including, that's after that recession. So this is actually cherry-picked a little bit. If you stretched it out another 5 years, it would actually go down to about 5% a year. That's all the stock market has made in our investing lifetime. But you have to sustain a 57% drawdown to get that money, which to me, this is why it always bothers me that all these asset managers, financial planners, financial advisors, they're always so eager to tell people, just buy and hold the S&P, just hold an ETF. It spreads out the risk. You can hold the entire stock market, all the companies. It's fantastic. Well, what they always fail to mention is that, little problem of the 6+ year 9 or 57% drawdown that you would have had to sustain. Because if you pull the plug, then you don't get all that recovery afterwards, and your 5 to 7% annualized return turns into zero very, very quickly. So again, people often overestimate their risk tolerance. Buy and hold S&P 500, in my mind, is a non-starter. Why would you invest in something that has a drawdown that much higher than your rate of return? This is insane. At least with this short VXX strategy, completely rudimentary. This is just basic step 1 of a 15-step process. It's already way higher return, and the drawdown, we're chipping away at it a little bit. Now, again, I will highlight that there are better ways to do this. We have our tactical volatility strategy. This launched in 2012 with the VTS portfolio. There are ways to really zone in onto the metrics that are truly giving you the most robust results, and you can get your rate of return fairly close to your drawdown level. Now, depending on how high the return or low the return, you can actually change this. Now, what I do, because for my risk tolerance, 40 is a little much. I mean, I can sustain it, but it's a little bit much. So I actually trade this strategy with roughly 0.6, 0.7 delta options. So it basically takes 70% of this. Get the drawdown to about 25 to 30, get the rate of return down to about 30%, something like that. And this is what I follow. This is just one of several strategies. It was actually removed from the portfolio right about there. And it was removed for the same reason, that we are just in a volatility regime change right now that, you know, it's actually just not worth holding right now. But it will be back. Come on, spreadsheet. The only reason that we removed it is we're just not seeing a whole lot of trends. So why have it? But it was in the portfolio for 10 years. It will be back, no doubt. And yeah, if I just do 0.6, 0.7 delta options, I can actually get this performance down to a very, very manageable level. It's the same thing that we do with our overall portfolio with VTS. You know, 22.5% return across our entire strategies. This is all live. This is since VTS launched, all paying subscribers. And drawdown, largest drawdown was about 25%, largely contributed by the first 4 months of 2022. That was not fun at all. But other than that, biggest drawdown was 11% and then 10%. So managing drawdowns is actually how I boost my performance. A lot of people out there, for some reason, when they say, oh, I want to get a better rate of return, well, what do? They chase, right? They add leverage. They try to find those big wins, that big gains. Post it on Twitter. You'll be a rock star. The way that I maximize my performance and my rate of return is by reducing the drawdowns. If you can get your drawdown portfolio-wide to below 30%, well, now you're onto something, because the S&P is at 57%. That's a non-starter, and you're only going to get 5 to 7% by doing that. If you can get your drawdown anywhere close to your rate of return, that's an excellent risk-reward ratio. So short vol strategies, obviously there is potential to make more than an average rate of return. Buy and hold on its own is 24. If we can just whittle away on those risk management spots and those low-hanging fruit areas where there's no reason to be holding it in that spot, maybe you can get yourself a 20% annual return with a 20%, 25% drawdown. That's the goal. You kind of want to keep those numbers as close as possible. Long term, that's going to pay off a lot. So that's how I would basically start if I was you. Now, I've been doing this for 17 years now, so I will share more and more as I go. But that is a very good start to get you guys going. And that's how you build a strategy. All right, like I said, start with buy and hold. It sucks. It's terrible. Nobody can do it. And then just start chipping away and adding things that can eliminate the worst spots. I would always attack the risk management rather than try to amplify the return. I think that long-term, you'll find your results are a lot better if you manage risk first and then try to get a good return after that. Kind of backwards. For some reason in this world, everybody chases. But there you go. So hopefully everybody enjoyed that little data corner. I will come back next week, of course, with a better one. So now we're going to go to a live trade. We're going to do the Wheel of Fun strategy. So the first thing that I want to do, though, some of you might not know what the Wheel of Fun is. I talk about it a lot on my live streams, but I've got a little video here. I'm only going to play 2 or 3 minutes, so please just bear with me. But you'll get everybody up to speed on what the Wheel of Fun is, and then I'll go ahead and do a live trade. So let's go ahead and talk about the Wheel of Fun. So this is actually coming from a video that I made over 5 years ago. This video was made. The Wheel of Fun. This is just a title that I gave it many years ago. You'll understand why I call it the Wheel of Fun in a second. But essentially what it is, you start out the wheel by identifying stocks that are either undervalued or overvalued. And I don't really mean on a fundamental basis. Typically, we are talking about price. So if you're talking about undervalued stocks, you're talking about stocks that are maybe depressed recently, maybe there's been a little bit of a market crash, volatility is going to be elevated. That would be starting the cycle with put options. And then if you see things that are overvalued, it's of course the opposite. You would be selling calls on that side and you would initiate there. Considering now we are seeing some difficulty in the market. So now would probably be more appropriate to focus on the put side of the equation. So that's what we'll start. But just remember that this can be done on both sides. So what you essentially do, if you've identified that we are in a depressed area with higher volatility, you start by selling a cash secured put option. Cash secured just means for every one option contract, that equals 100 shares of the underlying. And that's the multiplier that you're going to be using. This is sometimes how people get themselves into a lot of trouble option trading, trading because, option contracts in general are much cheaper than holding the underlying shares. So the broker will allow you to take a very large leveraged position. But I always like to do everything cash secured. So it's basically the equivalent of holding the underlying shares, and then you're just replicating it with an option strategy. This is not going to get you into any trouble. You start with the cash secured put option. And then essentially two things can happen. You can either have it in the money, which you would be assigned the shares and you would now be holding the underlying shares, or it would expire out of the money after the expiration cycle and you just keep your premium, it goes to cash and you go right back to step one. So this is kind of the start of the wheel. But then if you get assigned the shares, now you have to turn around and sell a covered call because you want to get rid of these shares. This strategy is not about capital appreciation of the underlying security. It's about making premium on both the put sale and then the covered call sale, exiting the trade with the option premium. So you're not really worrying about the underlying stock. And as soon as you get assigned, you're trying to actually dump those shares with the covered call. And again, two things can happen. You can either be in the money, that would make you lose the shares. Of course, you do keep your premium in all cases, and then you're back in cash and you could circle back over. Or if it was out of the money, you would still then keep your shares and you'd go another month longer and you'd sell another covered call and you'd do the wheel over here. So that's essentially why I called it the Wheel of Fun. You can see what's happening. It's a pretty simple system of selling a cash secured put, probably getting assigned shares, selling a covered call to get rid of the shares, and then you lose them, you're in cash, you keep premium on both sides, and then you repeat the cycle. So that is the Wheel of Fun. The thing you have to keep in mind with these types of strategies is when you are selling a put option, you are not reducing downside risk. So you are exposed to the full magnitude of downside risk of whatever you are selling. The only insulation you have is that really small premium that you collected up front. So it is only slightly more safe than just holding a stock outright and hoping it doesn't crash. So you absolutely need a stop loss for this strategy. But let me open a live trade and I'm going to actually Okay. So there is the simple explanation of the Wheel of Fun. Hopefully people understand what's going on there. We're essentially identifying something that we feel might be a little bit undervalued, sell a put option, probably, 50-50 or maybe 70-30. You're not going to get assigned the shares. You're just going to keep your premium and you're going to move on to another target. If you do get assigned your shares, well, then you still get to keep your premium, but then you have to turn around and sell a very aggressive covered call. And I say aggressive because remember, capital appreciation is not part of the strategy. I just want to dump it as soon as possible. So basically I sell those covered calls for a significantly higher premium. I don't want to lead it and hopefully, hold the stock for 4 months. Just in, out, get premium on both sides, and that's how it works. So last time I actually set up the trade where we use the XLF. That's this trade right here. You can see this is the XLF trade, and we opened this right when it was about just under 31. I think it was 30.75, and there was 30 days to go in that cycle. So if you look at the trade now, it's actually gone up $1, so not a whole lot. I mean, it's just a little bit up, but there is actually still 15 days left in this cycle. So this is where you can start to think about your capital efficiency. In the first 15 days, I basically capitalized 85% of the premium. It's already mine. I could wait another 15 days and I could probably get the extra 12 cents. I mean, unless XLF crashed in the next 2 weeks, I could probably stick around and wait. But for capital efficiency purposes, I can take this 85% of my money because it happened so fast. If I had 7 days left or 5 days left, I'd probably just leave it. It's not a big deal. But because it happened so quickly, I basically can just move this capital into a new trade and try to ramp up that initial premium again. So the first thing that I would do is I would actually go ahead and just close this trade. Try to get my 12 cents, I suppose. It's a credit, 13.13. I'm probably not going to get it. So let's just take 13 cents. Remember, I sold it for 86. So I got my 13. That's paying a debit to buy back the short of 86. So I got 73 cents in about 2 days. What is that? Or sorry, in about 15 days. What is 73 cents divided by, what was it trading at? 31.75, I believe. So that was a 2.3% return in 2 weeks. Now, sometimes people look at that and they think, oh, and 2.3%. Again, everybody on Twitter, you see 2.3%, you think, what kind of idiot trader is this? But you can imagine if you start cycling through these throughout a year, you've got a lot of occurrences and a lot of opportunities to make 1 or 2% here and there, and it really starts to add up. Then you can divide your money into 2 or 3 portions. You can layer your trades. There's many ways to ramp up the rate of return. The key to this Wheel of Fun strategy is just not biting off more than you can chew. You don't want to get into a situation where it goes too far in the money, because that's when you get the covered calls that won't actually be paying very much money. And typically you have to start selling them in the money at a loss. So you don't want to do that. Now I need a new target. So I think next time we do this, I'll do a stock screener, and I'll actually show you how you can find better targets. But just for today, because, we're doing a live stream and I want to get to the live chat, I'm just going to cut to the chase and see this IYR. This is the real estate ETF. I'll just open a new trade on the IYR. So I will look for a 29-day cycle. Something around a month, I think, works the best. So monthly cycles, I'm basically looking for 2% trade. So what is it trading at? 84. You can just take 84 times 0.02, just a ballpark. I'm looking to collect about $1.68. That would be a pretty good return for me. So if you look here, this 83.50 is fine. The 83 is even fine. So we can go ahead and actually do that one. I'll just show you what this looks like. 83 right there. So essentially this strategy works. I'm probably going to get some form of premium, but if the IYR goes below 83, I'm going to be on the hook for it. My break even, because I do keep that premium no matter what, I get that money. And then what I was talking about, the 10% total value stop loss, because when you're selling a put option, I have not reduced my downside risk by anything more than $1.54 here. Only the credit. Everything else I'm on the full hook for. So this isn't something, a lot of people throw that out. It's an income trade. I'm just making money doing what I would have ordinarily done anyway. None of that applies. You are essentially holding a stock. You're just enforcing a little bit of premium there. So I do use a 10% total value stop loss, which means at 83, one option contract is 100 shares of the underlying. That means this trade is going to use $8,300 in a cash secured method. $8,300, 10% of that is $830. So my stop loss, probably about there, give or take. My stop loss will be around 73. If it goes down below there and I've lost 10% of my money, remember I'm trying to make 2% give or take each trade, but I do have to get out. I'm not going to follow this thing for a 50% decline if it happens. So where is 73? Well, turns out 73 is actually significantly below the recent low. Not that it couldn't get there. Of course, anything can happen in trading. That's why we use a stop loss. But I'll take my chances. When you're a trader, of course, you have to allocate capital. So I think this is a good trade. So I would go into the IYR, 29 days to expiration. I think the 83 strike is good. If you wanted to go for a little lower premium, I mean, the 80 is fine, the 81. I typically target around 2%. And we will just fire this off. Let me try to get something close to the mid. It says 160. Let's do the 30-second rule. So remember, 30-second rule. Put in a price that you probably won't get. Remember, I'm doing a credit here, so I want the more capital, the better. 160, 157. Wait 30 seconds. If you don't get it, just drop it down 1 penny. Keep going. This is what we call the 30-second rule. These are computers. You don't have to wait all day. 20, 30 seconds is fine. And I probably should have started closer, but no harm, no foul. This is what I would do. You want to get your trades done. I don't want to wait for an hour trying to nickel and dime and get the best possible price in the moment. You can just kind of follow it down. Sometimes, probably most of the time, it takes 1 try, maybe 2, maybe 30 seconds to a minute tops. But it looks like it's moving away from me. Let's speed it up because it's a live stream. See if we can get that. There we go, 155. All right, I am now in an IYR Wheel of Fun. I took my profit on XLF. And this is my live trade. The last thing that I always like to do is I just leave this red one for Thinkorswim. This is the live trade highlighted here. The red one is not the live trade, but I like to see the premium. So essentially I can gauge where I'm at here. But I do mark my stop loss roughly 830. Maybe throw a double line over there so it's very easy to see. And now I just, with the price right here, I'm just going to let this thing go. I've got 29 days to expiration. Just see what happens. I sold the 83. So if it expires above 83, everything is done. I keep my premium. I'm back in cash and I'll find a new target. If it's below 83, I will get assigned at 83. So let's say it goes down to 78. I don't get it at 78. I get it at 83 and I do get my premium. So my break even is at 81.46. If it's down here, well, then that just means that the covered call will probably pay me less to get out. Ideally, you kind of want it to hover somewhere around here. Maybe I can just get out with my premium and then next month I can basically circle back and do the IYR again. I can do the XLF again. That's kind of what I do. I get used to having, 15 or 20 stocks and ETFs that I'm very familiar with, and I just keep going back to the well over and over again. Rinse through those, and again, we're churning premium here. I don't care where the IYR goes. I'm just trying to collect a put premium, covered call premium, aggressive on both sides, and just get out. Don't forget your stop loss. 10% stop loss. You have to do it. I've been in trades in the past where you think, well, I'll just let it go for a few more days. It'll come back, I'm sure. Well, sometimes it doesn't. And then you end up, now you're down 20%. Now you're down 25%. Your covered call is going to pay you 2 cents to get that covered call. So then you have to bring it down. And if it happens to trigger, then you lost capital appreciation. It's a nightmare. So don't go too close to the money, but definitely do aggressive. And as long as you're using a stop loss and the cash secured method, because remember, options are cheaper than these stocks to hold, the ETFs to hold. Your broker will let you do 5 or 6 of those for the same amount of money. That's a massively leveraged position. So do cash secured and a stop loss. You're going to be just fine. Can't get into trouble, and then you're good to go. So let's get into the Q&A. I see one question there already that is interesting. All right, so if you have any questions, put them down there. We will rip through this. That didn't take too long. Typically, I babble a lot, go off on these side tangents a lot. I'll try to contain myself, but I do get distracted. So here we go. The last position in the Iron Condor in GLD, why did you choose the call side with such a high delta? So for last week's, or the private live stream that we did, that's just FYI, if you're a member of the VTS community, take your free trial, free reminder, no pressure. But we do private live streams as well, where you can ask much more specific questions on our actual trades. But this is our live trade for the GLD Iron Condor. And essentially, on the high side, we did a 198-200. So you're asking why the delta was so high. Well, it wasn't when I sent out the email and when we initially did the trade, but it has moved a little bit. So you can see the short delta on the put side is 9 delta. And the call side will be very high right now. So the call side is up to 30. It definitely was more balanced. But when I sent the email out to do the trade, that day just happened to be one of those trading days where gold made a pretty substantial move. It was up about $4 intraday on the day we took the trade. So depending on what time of day you took your trade, the results can vary a little bit. What I always say, with enough trade frequency, everybody's going to be exactly the same. Sometimes you'll do a little better. Sometimes you'll do a little worse. Don't worry about, he got 56 cents for his Iron Condor and I got 53, so mine sucks. I'm not even going to open it. Just, enter and exit on the same days. Law of large numbers, over time, it will work out. But when I opened the trade, the put delta was about 13 and the call delta was about 18. So fairly balanced there. It's shifted a lot in the last 2 days. One of those things. Gold's on the move. I think it's back a little bit lower now, though. So another question. Okay. The commissions on an Iron Condor or Butterfly are very high. In the case of SPY or Qs, I use some futures, SPX or the RUT to save a lot. Yeah. So the commissions are not high. I was trading 15 years ago. You should have seen what we used to pay for the commissions. So they're not high. As a percentage of the potential profit that you make, and the fact that our Iron Condors are safe and a fairly well-performing strategy. Let me just open up a little plug here for my website. I forgot the screen share. I do that sometimes. All right, so Iron Condor strategy last year made 26%. That's in 2022. Stock market was down 20%. This strategy was up 26%. So when you're talking about commissions on a strategy that is consistent Most of the trades are profitable because we take extremely wide iron condors, very safe, long dated, 45 to 75 days out. The commissions are going to be a fraction of that. Now, I can't tell you, hey, it's nothing. Commissions are part of trading, but you can't avoid commissions. Now, fortunately, commissions are based on number of contracts. So it actually scales relatively based on the trades you're doing. Iron condors are a higher probability trade. So you're paying commissions on 4 legs and you just pay the commissions. That is just what it is. Now, you should probably make an effort to get low commissions at your broker. Don't go to the highest commission broker. There's no reason for that. Back in the day, that's the reason I switched my portfolio to Interactive Brokers, is because I used to pay a fortune trading at TOS. Nowadays, it's getting a little bit closer. Interactive Brokers is better, but TOS is fine. I wouldn't worry about commissions too much. It is just part of trading. What you really want to focus on is making the most money you can with the strategy. It's the same thing that I always tell people with tax efficiency. It's like the 10th thing you should be thinking about, honestly. Tax efficiency. Just pay your capital gains. I would rather have a good strategy that is very successful long-term. And then, I have to pay some commissions. I have to do some, short-term capital gains sometimes. That is so much better than going to some type of silly buy and hold pie chart that's going to make 3% a year just so you can be tax efficient and just so you can check all these boxes of low fees, low expenses. Come on, let's just try to make the most money we can. And when the time comes, if you're faced with a decision, I can get the same return with this commission, same return with that fee, well, then choose the lowest one, obviously. But don't ever sacrifice one for the other. Rate of return and robustness of the strategy, reduced risk management, that's always number one. Fees and commissions and taxes, that's like 10th in line. So not to belittle your experience with bad commissions. I don't know what broker you use. Maybe you should switch, but TOS, Tastyworks, I don't know, Fidelity, Schwab, all these things, they're probably fine. Okay. Where does the Wheel of Fun strategy fit in? The strategy is not part of the VTS portfolio. Where can we track these trades? So good question. You are correct. It is not part of the VTS portfolio. I showed you the actual portfolio. You know this. You're in the community. 5 strategies, 20% each. None of them say Wheel of Fun. So the Wheel of Fun is actually part of the VTS Options Academy. Now, the only reason that you can't see it right now is about a year ago, we closed it down. It used to be a signal service, just like the VTS community, and I would just send out the daily trades. The problem that I encountered managing 2 separate services, one for ETF trading, one for options trading, is I had a ton of questions about all the option strategies, and that's fine. I like the questions. Education's super important. That's great. Ask your questions. The problem was I didn't really have an underlying explanation, complete A to Z explanation of any of the option strategies. There was a couple videos, couple articles. Makes sense to me because I've been doing it for 17 years, but somebody new coming in, naturally they have a lot of questions. So I decided about a year ago I would shut the VTS options down and I would relaunch when I build an actual course, which would have, 10 to 20 videos for each individual strategy. And then there's probably going to be far fewer questions. People are going to feel like they get the strategy and I actually teach it and now it's theirs. They could unsubscribe from VTS and they still get full knowledge of the strategy. So that's the direction I'm going with my options trading is I am just going to teach the strategies, just give them to people. And I'll be there in the live streams. We'll do all the live trades just like we do before, but I do want that course underlying. So you are correct. VTS options right now is shut down. So you can't really see the Wheel of Fun. This is just something I'm doing during the live streams for fun, just for people to follow along. But that is coming for sure. Is VIX below 12 too low to initiate a calendar spread? I don't have enough information on this one. Calendar spread on what? The VIX itself? If the VIX gets to 12, and I don't know how long we're going to have to wait in this economy until we see a 12 VIX again. You might have to come back 5 years from now and you're still asking this question. The way that this economy is going, I mean, who knows? But if the VIX was at 12, I would be leading the calendar at around 14 or 15. If you're talking about VIX options. No, it's not too low. You have to remember that if you're trading shorter dated calendars where you're actually taking it closer to expiration. It's not your question. If you're taking your calendars closer to expiration, they will behave like short Vega trades, kind of similar to an Iron Condor, because that short month is the larger short put, right? Or the short sale. So that will decay faster than the long. But the way that we trade them, 45 to 75 days out, long term, we never hold them very long. They're always closed out with a 50% stop loss for the Iron Condors, 25 for the calendars, but they don't get within 30 days to expiration. So the calendars actually do behave like a slightly long Vega trade. So the lower volatility gets, you would move away from Iron Condors and you'd start moving towards the calendars, because the Iron Condors are very strongly short Vega. The calendars are either neutral or long Vega, as long as you're not taking them to expiration. So that's what we do. I trade both of them. And your question, I'm assuming VIX at 12 is a, proxy for low vol, basically. Low vol, you would want to shift into calendars. So that would actually be the right thing to do. Right now, it's Iron Condors all day because, like I showed before, even though the VIX says 19, that's high. VIX and 19 is high right now. So it's not a good time for calendars. You want to wait until volatility gets lower. Okay, here's one. I think you were answering the question of, I asked which one of those percentiles do people actually think would have led to the best results. So I think somebody said the 90th percentile, somewhere in here. That's kind of what I was expecting a lot of people to think, because there is that idea that being a contrarian and shorting those volatility spikes, I mean, anything over 25 is starting to get pretty high for the VIX. But that's not a good time to short the VIX. As you can see, if you shorted VXX during that period, it's very hit and miss. Sure, you can do well if you call it perfectly, but if you don't, you could be in an excruciating drawdown for a very long time. So I do not play the contrarian game with short volatility. I am a trend follower. You could call me a volatility targeting manager. That's what I do. There are certain pockets that we just know historically, that's a good asset class to hold. This one's not a good idea to hold. It doesn't mean they can't work out at times, each one of them. I mean, you could hold the absolute wrong asset class in the moment and it might still work out. But obviously, if we're going to be doing this for 30 years, we want to be investing until we're, older. Unless you're 79 years old right now, then I don't know. But yeah, we have a 30-year time horizon here. So I want to do the right thing all the time, and then just rinse, repeat. Over a large number of occurrences, that's going to lead to the performance. I don't want to be guessing, I think this time's different. No, I think, it's at 25, but I'm going to short it this time because I just feel it. I don't do that. I'm in the right asset, in the right time, with discipline, and I just have a long-term mindset. So I wonder if your results would be different if you compared VXX with VIX9D instead of VIX. In the future, I will add the cash VIX term structure, the VIX9D, the VIX, VIX3M, VIX6M to the mix, and I will go through all the numbers again and show you that there are improvements. The cash VIX term structure, especially the relative differences between each one of them, is definitely way stronger than the VIX. The VIX index itself is a pretty terrible metric for getting trade signals, to be honest. I just used it as an entry level to get people started, get people thinking about these things. But yeah, if you're designing a strategy for the long run, you would want to focus on the VIX9D, 3M, 6M, especially the 3M, 6M. And then, of course, the VIX futures, the roll yield, all of those things, volatility risk premium. You want to stick to the good ones, the really top level metrics. But the VIX is everywhere. Everybody talks about the VIX. If you want your articles to get more views, just hashtag VIX. There you go. So that's why we started there. How did you and your wife meet? How long have you been married? I highlight the married part because it's okay. So we met, she's watching right now, so I better get this right. 13 years ago, over 13 years ago now. We've already had our 13th anniversary. So she was a yoga teacher at the gym that I was a member at, and I used to see her going in and out of her yoga classes. And I thought, oh, well, I don't want to be too much of a creep. Just first time I ever see her, I just ask her out, especially when she's at work. So I had the brilliant idea of starting yoga, and I would only go to yoga in her class. It's not like I was getting into yoga or anything. I was just going to her classes, stalking basically. And I went to, I think, 6. I think I made it 6 yoga classes. She's very good at yoga. So she was doing, and in the ranking of all the yoga instructors, she was the one that did all the, it's called vinyasa yoga, power yoga. She was doing all the poses. She can, just on her hands, or she can hook her legs around. She does the really tough stuff that, for me, I basically was just sitting there. Just, the whole half the class can't do anything that she's teaching. So I think I made it 6 of those. And then I asked her out. She said yes. The moment we went out, first date, I never did yoga again. So that was how we met. As far as the marriage part, we've been together for 13 years. We just got married last year. So we were together for over 12 years. No marriage. Lived together from basically the first 3 months. So we've been married for 13 years. We weren't officially married is all. So we did go to Las Vegas last year. 2 years. Oh, she's watching. Yeah, I screwed that one up. I think 2 years ago, year and a half ago. I'm digging myself a hole here. 2 years ago, we got married. We went to Las Vegas and got married. So that was kind of fun. All right. How long do you think will the Fed take until they lower the rates? Well, in one of my early videos for this year, 2023 predictions, one of the 6 predictions that I said was that, I believe in the video I said, in the June meeting, they will not raise rates. And then in the September meeting, they will cut by 25. So I'm sort of thinking that they're probably going to raise rates one more time, and then they're going to stop and not do any rate cuts. They don't want to give the illusion, the appearance that they've made this big mistake and just reverse course. They're not going to cut rates by 50, after raising rates by 50 or 25. So I think there's going to be a 1 quarter pause, and then they're just probably going to come back down. I don't know how I feel about it, to be honest. I hope not. I mean, generally speaking, I think that rates should be higher. I think that where we're at right now, it should be fine. It's just that they've broken the market so badly for so long that it's actually really difficult to know what to do at this point. So it's also another reason I can tie it into that one segment of the percentiles. You can see this percentile. Well, the same thing happened in 2007 to 2008. So this is the mid-level VIX, mid-level volatility levels. And if you short the VXX during this period, it should work out pretty well. But there will be times when, if you're heading towards a recession, you're going to get a lot of whipsaw and choppy action. But because in the financial crisis, it didn't happen very quickly. Like in 2007, things started to, go badly. And by the end of 2008, it just fell off a cliff. And by 2009, everybody had it kind of out of their system. Stock market crashed 57%. Everybody kind of was in the mode, okay, well, we're done now. And they did the TARP and they did the auto bailout. But in large part, it basically just flushed out of the bottom. And then we had a really good period. Well, what they're doing now since Volpocalypse, we had Volpocalypse, Q4 2018 crash. We had the 2020 pandemic. 2022 was an ugly year. We're basically just financial engineering our way to dancing on the edge of a recession, but not actually getting the recession. So this period, which should probably have only lasted 2 years, now it's lasted 5 years because they're still going with this stuff. Honestly, after COVID, during COVID, they probably should have just let it flush out and just, it would have been painful at the time, but, spending that much, trillions of dollars for what? So now we can have a mediocre market and we can have everybody confused as to what's going on. What was the payoff there? I think the old style of kind of letting it go pretty bad, pretty awful, because that's what would have happened. I mean, the stock market crashed 34% at the bottom of the COVID. I bet you it would have got to 50 if they didn't, inject trillions of dollars and all that stuff. But I think we would have been healthier for it. So, I mean, that's a long-winded answer of saying I have no idea what's going on. I have no idea what they should do at this point. every case that I can make that they should go this direction, there's an equal number of things that, no, that's wrong. They should go that way. So it's a big mess. We'll just have to see what happens. My recommendation for everybody would be focus a lot in the next few years until we get some real trends going. You're going to want to churn through your market neutral strategies a lot harder than you normally would. In a strong trending bull market, yeah, Iron Condors might be 5-10% of your portfolio. Now, I crank that up. Mine's 20% right now, and I still take a few extra in the VIX options portfolio as well. So our volatility trend strategy, the way that we short the VXX with butterflies, we've got a couple of trades on right now. This method of shorting volatility with more market neutral butterflies, this is a live trade we have now. You can see there's zero risk to the high side. So volatility spikes, we lose nothing. We're basically just trying to get this middle range. And then if it really crashes hard, then you lose some money. But what are we seeing? The market is having a very difficult time trending strongly. So I mentioned that I actually have, in the last year, let me close some of these windows, I actually have moved away from the pure trend following strategy that worked so well for me for 10 years. I actually removed it from the portfolio right at the end of 2021, and basically trying to replace it with things that I think are a little bit more neutral. So I can't give anybody any investing recommendations, but I suspect the market will have difficulty getting a real solid trend for a while. I think that what we're seeing now, it might actually stay. That, like I said to a previous person, I don't know when you're going to see a 12 VIX again, but boy, it would surprise me if it was this year. I just don't see that happening. There's too much trouble out there. There's too many ways this can go badly. So personally, I'm going to be doing more market neutral stuff. And shameless plug, of course, if you want to learn about the Iron Condors, we actually have a full 25-part Iron Condor series that all the VTS subscribers get access to. So if you want to take that free trial, there is actually a link at the top of the chat. You can go ahead and take that free trial. And like I said, I'm not going to be offended at all if you stick around for a couple of weeks, couple of months, see all the live trades, and then move on. You're not going to hurt my feelings, but it's there if you want it, and you do get the Iron Condor course with it. So, all right, let's keep going. You think there is any merit to a VXX diagonal out of the money put strategy over the long term? Selling the higher strike, nearer term contract, and buying the longer term, lower strike put. I do butterflies. Diagonals are very similar, so choose your structure, I suppose. I just think that the butterfly, especially the broken wing butterfly, like I just showed, I just think that this, I churn through these basically every 1 to 2 weeks. I just layer and churn, and I just think this structure works the best. Of course, you could do an out of the money put diagonal as well. I just choose your structure. They're all kind of the same. You could even throw up Iron Condors as long as you lead them that way. It's all kind of the same. Can you please share the results of each of the 5 strategies in the VTS portfolio over time? I can ballpark it for you. I used to put that like super detail on the website, but everybody knows my nightmare with my emails. It got to the point where I was answering 5 to 6 hours of emails, and a lot of that bottleneck was questions about strategy performance and all that stuff. So I found the more detailed I showed is actually worse it got. So right now, what's on the website? There's no individual strategies, but I do, of course, show all the videos for all the strategies, all the performance. You'll see everything on here for the portfolio. I just didn't divide it all up into the individual strategies. So if you're interested, it says defense. All this is leveraged. We have 2 portfolios. We have leveraged, and then we have the unleveraged. Now, based on questionnaires and the number of questions that come into my email, I know that probably 95% of people are following the leverage. So that's why it's listed first. These tactical strategies, they're roughly, these 2 here, roughly 25% a year with roughly 25% drawdown. Tactical balanced is lower because it does include bonds and gold, which of course don't, it says cash now, but if the Fed is in a normal environment. That always says IEF bonds. So this one is about a 20% return with a comparable drawdown. And then I showed you the Iron Condors. It's about 17% return with a 15% drawdown. And the volatility trend is roughly 18% return with maybe a 14, I think, percent drawdown. So like I said, I basically do target that pretty good balance between rate of return. Come on, where is that? That's hard to click. Between overall portfolio return and overall risk. I have a video on the YouTube channel where I also designed my own risk-adjusted metric. It's called the VTS Performance Score. And essentially what it is, it's kind of like the Ulster Performance Index, but instead of dividing by the Ulster Index, I'm dividing by the average of the 3 largest drawdowns. Because I personally believe that, yes, duration of drawdown sucks, but it's actually kind of the magnitude that's the most trigger point for people to leave a strategy, to basically pull the plug and leave. So I divide by the average of the 3 largest drawdowns. And all 5 of our strategies are performance score over 1, which is good. That's what I'm targeting. That basically means that the performance is better than the average of the 3 drawdowns, which, again, very hard to do. If you just look at the apparently 90% of the world's favorite buy and hold S&P, well, what have you got? You've got a 7% return since 2004. 7% annualized return for the SPX. Largest drawdown, 56.78 in the financial crisis. Second largest drawdown would have been, it would have been 34% in COVID. Third largest drawdown would have been 22% 26% in 2022. That actually surpassed the Q4 2018 crash. So you've got 26, 34, 57. You're talking about a performance score of like 0.2 or something, 0.15. It's terrible. Buy and hold on the stock market. Please just follow my podcast, watch my videos, read my articles. I can definitely get you a risk-adjusted return far better than the S&P 500. Let's set the bar a little bit higher than that, people. So yeah, that's what I would say. I don't show the exact details anymore because I know what that leads to, but they're all kind of about the same. I'm targeting 15 to 25% a year. I'll take that forever. I don't know if it'll sustain over time, but that's the goal. That's the target. Number one, though, it has to be a manageable drawdown. Without that, the return doesn't matter. A lot of people get into this trouble, and I'll go off on a little side tangent. A lot of people will look at a performance chart, and they don't fully put themselves in the shoes of a person who actually followed it in live trading. They'll look at the results. They'll think, oh, that's a good rate of return. Look at that. That's a good Sharpe ratio. I like that. Oh, the drawdown, yeah, it looks pretty big, but I'd be fine because I like that rate of return. But what they are not realizing is that emotions are one of the biggest parts of investing. And unfortunately, people overestimate their risk tolerance. If you were actually in that drawdown, probably would have pulled the plug. I mean, how many people actually held on to their, let's say they were in a roughly 60-40 portfolio during 2022. How many people actually held on to that? Just buy and hold, just said, you know what, this is going to recover. It's going to be fine. Your stocks are down 22%. Your bonds are down 30%. Are people really going to stay the course to get a 4% long-term return, 6% long-term return? I mean, it would be different if you could realistically expect it. Okay, I'll wait it out. This is super painful. I'm down 25%, but long-term, maybe I can make 25%. That would maybe be worth it. No, these are people who are in buy and hold portfolios sustaining a 25% drawdown that at best they're going to make 5% going forward. This is not a good equation. So I just think that people really need to understand that in real time, drawdowns are a lot worse than they look on paper. So even my drawdowns, even though I'm able to keep them at or below the long-term rate of return, it still sucks. It's still painful. And I still get not only me complaining, like, come on, like get these strategies going, but other people will complain as well. It's just drawdowns hurt. And the ratio of drawdown to rate of return matters a lot. So don't overlook that. This one I'm going to have to punt on. I don't really know much about prop firms. I've never traded at a prop firm, have no plans to ever do that. So I don't really know what's going on in that world. You'd probably have better information than I do. This is in reference to me basically stalking my wife in her yoga classes, which I don't know if that's creepy, but it worked. There she is, watching my live stream. It's got to be super boring, right? I can't believe she does it, but she does. All right, what's the ideal profit target for an iron butterfly? I like to take, well, if you're talking about our VXX ones, I should be careful here. So if you're talking about something like this, which is our volatility trend strategy, I don't use stop losses in this strategy. I'm churning 1 to 2 week trades. I'm layering them over and over. And I'm just accepting to the fact that occasionally you'll get some losses, but most of the time it's going to expire in this range. And I'm just layering them over and over. It's a very small allocation per trade. These are 1% trades. So they're very small, and I just want to get the trade frequency going. So I don't actually stop out of any of these. But if you're talking about the S&P 500, for example, the only Iron Condor we have now is this. If volatility was lower, we would have opened something else, a calendar. So calendars, I would take a 25% stop, Iron Condors 50. If this was an Iron Butterfly, it's basically the same thing as an Iron Condor. I would say 50 is a good level. You do want capital efficiency. So it's kind of similar to that XLF trade that I closed out for the Wheel of Fun. I could wait 2 more weeks and get my extra 13 cents, but I've already taken 75 cents. Iron Condors are the same. Iron Butterflies, choose your poison. It's the same thing. We're going 45 to 75 days out. Most of the time, you can get half your profit in 3 weeks. Why would you wait 40 more days to get the other half of the profit? And then you'd be dancing on the gamma knife edge where any movement in the market as you get closer to expiration, it's going to be wildly swinging those prices. I would rather just use the stop losses at a 50% of the premium either collected or paid and just get out and just take that premium and move it to a new trade and keep churning more trades rather than waiting 65 days to get that full thing out there. So I would say no matter what your, let's call it the defined risk option spread that you're choosing, Iron Butterfly, Iron Condor, calendar, diagonals even, they're all kind of the same thing. They have slight different purposes, but I'd take stops in all of them. Stop gain and stop loss. So if you've got the profit, get out. If you've got your loss, get out, move to a better trade, and move on. I don't try to fix the trades. I don't try to do any Iron Condor adjustments. I just layer as many as I can get, as diversified as possible, use the stops, and my capital efficiency is very good. So long-term, it just pays off. Do you ever, caps locked. I don't know if you're angry. I do get yelled at for not talking about UVXY more. Do you ever bother with UVXY? Yes, when I'm trading the volatility trend, our butterflies, oftentimes I use UVXY. The only reason we're not using UVXY right now, and both of our trades are on the VXX, that is because the UVXY has not done its reverse split yet. So we opened another trade just recently. It's this one here. So you can see here's the price. This is a short volatility trade with no or very little upside risk. So this is why I love these. I can just churn as many as possible, 1% of capital. This is the volatility trend strategy that we are doing. You can see we've got 2 going now. I just get into as many of these as possible, and I just keep churning them. So I'm basically hoping that the VXX bleeds down to here. Now, I could easily do the exact same thing on UVXY, and we did basically all of the last 8 months. We used UVXY. But when the price is down at, $5, it's actually really difficult to trade this thing right now with options because the gap between $4.50 and $5 is pretty big, right? If you take these trades, I can even show you on VXX. Right now with VXX, if you look at the trades that we're taking, these prices are pretty high. So the difference between them is quite low, relatively speaking. But because it did a reverse split recently, we can see the old pricing. The gap between this is not going to be very conducive to option trading. And it's even worse now with UVXY. We're talking about, if I wanted to take this, I'd be setting up a 350, 250 butterfly. that's just difficult to manage. That's a big spread between them. It's possible that it would land in just the right allocations at just the right time, and it might make sense. But overall, you definitely want this thing to reverse split already. They'll probably do a 10-to-1 pretty soon, unless they're just trying to scuttle the thing. I don't know if that's true, but yeah, we do. Don't be mad. I don't know if you're caps locked because you're yelling at me, but I do get yelled at a lot. I like UVXY. Options only. Defined risk options only. Never undefined risk on any volatility trading. Just don't. And then you're fine. If you're using options, defined risk spreads, there really isn't any difference between VXX and UVXY. And if the UVIX, which is the 2 times leverage product, if that starts to get option volume going, nothing wrong with option trading on UVIX as well. But obviously don't short it directly. That is an unlimited loss trade. And don't sell undefined options on these things either. Sorry. I will in the future be more cognizant of this. And yeah, I'll mention, anytime I say VXX, I will make sure that I mention, oh, by the way, you can do UVXY as well, so I don't get yelled at. Okay. Yeah. Thanks, Nick. That was an entry level. So yes, come back, tune in to every week. I'll prepare something. The data corner seems to be people's favorite one. We dive into topics. So we will be back with several follow-ups to that stream, and we'll build you an even better short volatility strategy. But I like to talk through those things because a lot of people skim over that, and I'm a pretty detailed person. I like to take my time with the strategy building and really explain it all. So hopefully people learned a few things today. Do you know the date? I do not. Unfortunately, I don't. They're basically whenever. We will see. It should have probably happened by now. I think the average when it happens is around 750. That's a spreadsheet. It'll crash my computer. It's about 750, but it has been as low as about 350 before. So anywhere from about 12 to 350, there's been, what, 10 reverse splits in the UVXY. And the average of the 10 happens at 713, I believe. So it's past that. But it's not unprecedented to go this far. It has happened before. And I don't know why. Internally, to me, it doesn't make any sense. Why wouldn't you want to give people more access for it to be tradable? Taking a 10-to-1 reverse split and making it go back to 45, I can understand why they wouldn't want the thing to be in the hundreds, but 45, that's fine. Maybe they're anticipating a market crash. They're thinking, well, if we just hang on here, maybe this thing will go up to 45 on its own. I don't think they're doing that. I'm just joking. All right. I tried to look for that earlier this week. I don't think it's been announced yet. It hasn't as far as I know. But what you want to do is you want to follow a few volatility traders on Twitter. So I always kind of get a kick out of it. The big competition is between David Lincoln. So you should follow the famous Dave on Twitter, or just search David Lincoln, or you could search the Short Vol Show. One of those three, it's going to pop up. So it's always David Lincoln versus Vance Harwood. And I don't, they bounce back and forth and who gets the announcement first. But follow Vance, it's at Six Figure Investing. And follow David Lincoln, I believe it's at the Famous Dave. Famous is FAMIS. And one of those two people will absolutely nail the announcement. And follow VIX and More, at VIX and More. Bill Luby will also announce that reverse split when it happens. So I'm always late to the party. I'm not really active on Twitter. I'll probably get it a day later, but you probably want to follow those people ahead of me. So you'll get it as soon as it happens. All right. That's all the questions. So that was pretty easy. Usually there's more. So thank you everybody for the support, and please give the video a like on your way out. There was not very many likes so far. We had way more people watching than likes. So if you would be so kind, just give it a like. I should have mentioned that at the beginning. I'm terrible at this YouTube thing. Although, while you're watching, let's screen share this. Let's go here. Ready? Dashboard. Refresh. 24,998. So everybody watching right now, if you are not subscribed to my channel, first of all, what are you doing with your life? This is the volatility channel. But secondly, push me over that 25,000 level, please. So, and actually the YouTube analytics are pretty detailed. I think roughly 75% of my views are coming from people who are not subscribed to the channel. So give it a like if you're here, but subscribe to the channel. You'll get the notifications and all that stuff, and I will get over 25,000. My ultimate goal is 100,000. I'm a minimalist. I don't really buy much, but I've got something in mind that I'm going to buy myself when I hit 100,000. So help me out, and it'll be pretty cool. I'll announce it some few years in the future when I hit 100,000 YouTube followers. But definitely subscribe. And like I said, this is step one of a long strategy building process. But stay tuned to my podcast, and we will go through all of this. We will get you to the point where you're very confident trading that short VXX, and you will never have to listen to these people telling you to just buy and hold the S&P 500. I think we can set the bar a little bit higher than that. So thank you, everybody. I will see you next week.